This is Bloomberg Surveillance Early Edition with Dani Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. China slides into deflation. The country's consumer and producer prices decline together for the first time since 2020. So far, so good for this week's historic Treasury debt auction. 3-year notes get a bid. Up next, we get 10 and 30-year debt sales over the next 2 days. And as SoftBank's arm gears up for what promises to be the biggest tech IPO of the year, Amazon joins the party as a key investor. Welcome to Bloomberg Surveillance. This is the early edition. I'm Dani Berger in London. Kriti Gupta is in New York. Kriti, a bit of a breather from that bank sell-off. Bonds, though, still getting a bid today.
Yeah, well, risk sentiment is turning on its head, though. And if you look at that in the equity market, it really comes out as green on the screen here. Futures higher by about 0.4%, 45.34 on those contracts for our radio audience. But Dani, to your point, it is the bond market that's getting a bid. But you really have to go way out into the curve to see any real sort of conviction. The 30-year yield at about 420 or 419 is what we'll call it, down about 2 basis points. Because if you look on the front end, the 2-year or even the 10-year, for example, kind of in that mid-range, it's not doing a whole lot this morning. So really interesting to keep that in mind, given, again, the questions of digesting some of that supply that we are going to get today and tomorrow. Dani, we're going to dive into that in just a little moment. We're going to talk about the Asia index, though, because, of course, we are seeing a lot of movement in China. A lot of that's going to be driving the trade this morning. And I think it's important to keep in mind that you are actually seeing the yuan strengthen overnight. That is a big deal, given it has kind of snapped a 3-day move from after the fixing. So dollar yuan now at about 722 is what we'll call it. The dollar weaker by about 0.3%. Of course, a lot of that's going to have a read through into the commodity index. Of course, as you have a weaker dollar, commodities broadly are going to be higher. Gold, copper, oil, you name it. In addition to the fact that you are going to see China perhaps doing a little bit well. There is some cross-asset movement there. But Dani, speaking of cross-asset movement, let me bring you a redhead that just crossed the Bloomberg terminal. Rice in Asia. Remember, rice is the largest used commodity around the world in terms of food, in terms of soft commodities. Well, it's soaring to the highest level since 2008 on the supply risk. This is a really big deal. We know that protectionism has been a really big part of the global conversation, especially when it comes to India, one of the major exporters, and just the fact that a lot of the developing world is very dependent on that. So you are starting to see, because of those supply risks, the price hit a real record.
Yeah, it's a global story. There are risks everywhere with agricultural commodities, not just weather. You have war, issues like that. Here in the UK, we certainly are facing food inflation that this week, the BOE's chief economist, Hugh Pill, said that it's not going away anytime soon. Okay, it is a relief rally here in Europe about banks. Italian banks and the entirety of the banking sector is coming back. European banks fell over 3% yesterday. We're up nearly 2%, so we haven't made up all of those losses. But Italy, late yesterday, perhaps sensing this turmoil in the market, issued a clarification on their windfall tax. They say, hey, banks, it won't exceed 0.1% of your profits. And if you've already increased the deposit rate that those coming to your bank are getting, then we won't affect you as much. This won't affect your bottom line as much. I didn't really give too much clarification on that, but again, trying to calm things. So not just the overall bank index, but Italian banks to the FTSE MIB, that's up 2%. Meanwhile, the bond story is the same here, Kriti. We've seen this huge rally in duration in Germany across European sovereign debt. I just brought up the 10-year yield in Germany to show that it's not moving, that finally it's a day without volatility. Just when a flag in about 30 minutes time. It's not just the U.S. that gets auctions. A German 10-year auction will be going through. If there's any significant moment, Kriti, we'll bring that to our viewers.
Yeah, a lot to digest here. It's going to be really interesting. I feel like we haven't talked a lot about the Asia read-through in maybe a couple of days here, Dani, but I think we're going to snap that today when it comes to today's trading session, at least here in the States, because we did get some economic data. China's consumer and producer prices both declining in July from a year ago. To sign that deflationary pressure, well, it's likely to be temporary as policymakers face calls to step up monetary and fiscal support.
China is in deflation for sure. The question is how long?
The market lacks some short-term confidence. And that is probably because we've had a lot of supply-side policies. But until we solve the demand-side issue, there's still going to be a bit of a gap.
Investors are really clamoring for broad-based stimulus. I don't think that we're going to get that.
There's no reason not to be optimistic about the future and the long-term prospects of China.
Jill Deese, Bloomberg's China economy and government editor, joins us now. Jill, what's so fascinating about the China story specifically is that if you are indeed worried about exporting deflation, that could actually be welcomed by a lot of the central bank governors around the world. Walk us through what this data actually means.
Hey, Kriti. Yeah, that's right. I think that at this point, really, it's everybody's looking at that CPI gauge, right? Because factory gate prices, of course, as we know, have been in deflation for, I think, about 10 months now. A lot of that has to do with softer commodity prices. But when you look at that CPI gauge, remember, I mean, the last time we actually saw consumer prices in deflation in China was late 2020, early 2021. That's right in the middle of the pandemic. Now, though, I mean, this was supposed to be, 2023, the year when China was emerging from the pandemic. The economic recovery was supposed to pick up, and a lot of that was supposed to be consumption driven. I think what you're seeing feed through in those weaker CPI prices is, that lack of confidence, particularly among households, trying to get people to spend. Yes, I think that, from a global perspective, there is maybe some read through where central banks in places like the U.S. and Europe might actually, this might come as a bit of a relief for them if they're looking to, look for any sort of help from elsewhere in the world on how to tame higher inflation, particularly in the U.S. and Europe, although I would caution that's a bit limited considering how much the U.S. and Europe have worked to ring fence some of their operations from, a certain exposure to China. But yeah, I think what you just heard that in the collection of clips there from a bunch of experts, though, is what we're waiting to see is how much this pushes policymakers within China to maybe introduce some additional policies to help boost demand within China. I do think that's going to be somewhat limited, but we'll have to see what that looks like in the coming weeks.
And perhaps we already knew that this was coming, hence not the biggest of market reactions. Jill, speaking of pulling back on investments, you mentioned this. The Bloomberg team does have a scoop on the U.S. limits to China investments, obviously chips in mind here, but it's not going to be as extensive as we originally thought. What do we know about what the U.S. will do, what they will enact?
That's right, Dani. So look, I think what we're hearing right now about these potential investment curbs is it's a lot less ambitious than maybe what was originally proposed. The idea being that the U.S. wants to limit American investments in certain sectors in China, particularly quantum computing, artificial intelligence. But this proposal would limit that to companies where they have more than half of their revenue coming from those particular fields. So that, in theory, would make it okay if you're an American investor to invest in a Chinese conglomerate where they do some work there, but it's not more than half of their revenue, right? And I think the other thing, too, with some of these proposals is that it could be that it's not retroactive. So maybe once the plan is in place, if you were investing in something prior to then, it's actually okay. What I think look, on the heels of the Janet Yellen visit to China just recently, she made a point of saying that they wanted to target curbs on China. They want to continue working with this relationship. We know how important the relationship between the world's two largest economies is. But yeah, I do think this is a bit of a softening in the U.S. stance, at least in terms of what is proposed in the investment curves here. Yeah,
a lot to digest out of China. Joe, we're going to throw one more at you. The country garden default, now Bloomberg Intelligence saying that it could be worse than what we're hearing out of Evergrande. Walk us through just the significance of this story.
Sure, Kriti. Well, I just explained to you a few minutes ago, about all these concerns with the economic recovery in China, lack of household confidence. Why is that? In large part, it's because of this ongoing property crisis that we've been dealing with for years at this point. I think that what you're seeing in the country garden, issues right now is sort of more symptomatic of those issues, right? I mean, this is the 6th largest developer in China by sales. I think any concerns that they're missing payments, if that creates liquidity concerns, if that creates concerns about failure, this is a developer that has a lot of big projects in China. I think that that's just, continues to feed those concerns that the property market crisis in China isn't going away anytime soon.
Yeah, a massive company, bigger than Evergrande, and probably a name that, a lot of our international audience outside of China might not have heard of. So, Jill, thanks for keeping us on top of it. Jill Deese there with the latest. Now, it also might be a reason we saw bonds rally in the Asia trade yesterday. Now, speaking of that, we did have Tuesday's $42 billion sale of 3-year Treasury notes, and did show signs of stronger than expected demand, had record stacks, and it is a week of auction deluge. Next is $38 billion worth of 10-year notes on sale. For more on this, let's bring in Bloomberg's Valerie Titel. Valerie, what will a strong or weak auction tell us?
Look, we're very sensitive now to the demand for treasuries. Now that we know that the U.S. Treasury is just increasing its issuance for these bonds for the next quarter, and we're likely going to see more issuance to come in the fourth quarter and next year because of this growing deficit. So a lot of attention on just what is the underlying demand for treasuries. We know foreign demand has been stepping back a bit, and we're looking for evidence in these auctions of just any weakness. Now, we didn't get that yesterday. The 3-year auction was quite stellar, but it's really going to be the 10-year and the 30-year that are going to be the better test. That steepening pressure we saw last week, that the yields moved higher, led by the long end, and that big questions over who are the buyers of this incremental size that the Treasury wants to issue when it comes to that long end paper specifically.
Well, speaking of that long end paper, I mean, it feels like we would have already seen some sort of signs of not being able to digest the supply being issued. We already had kind of warnings from that from some of the folks on Wall Street as well. But Valerie, we're not seeing that yet. Is there a chance that this all just kind of goes fine?
Well, it could be a chance, Kriti, that this is just more of a very slow-burning market topic. We know this is going to be an issue that is going to really be pivotal for markets maybe in the next 5 to 10 years. If you look at the Congressional Budget Office, their estimation for the Treasury market in 10 years' time is to double in size. That's definitely going to have some macro implications somewhere. It's just a matter of fact of when maybe the market begins to price that in, or perhaps this is just a very long, slow, growing macro trade.
Valerie, thank you very much. That's Bloomberg's Valerie Teitel. Now, in corporate news, Amazon is said to be in talks joining another tech company, other tech companies that is, there's more than one, as an anchor investor in the IPO of chip designer ARM. Now, the listing of the UK-based firm is expected to raise as much as $10 billion. Joining us now is Bloomberg's Tom McKenzie. Tom, first of all, a big IPO, which is exciting since we've gotten basically nothing. But what's in this for Amazon? Why would Amazon join on?
Well, for Amazon, they have AWS, of course, a core profit center for that business. And Amazon Web Services, well, their preferred chip is a chip designed by ARM. So that's the skin in the game for Amazon. They have 40,000 AWS customers. So obviously they want to see ARM do well, and that's why they're in discussion to take this anchor role. By the way, it's worth noting that Intel, Nvidia, and a number of other tech companies and other customers to ARM are also considering taking these anchor roles as well. So it looks like it's lining up to be positive ahead of this IPO, as you said, in September. In terms of the time frame, the roadshow is expected to start in the first week of next month, then the pricing the following week. In terms of what ARM gets out of this, the CEO of that company has made it very clear they want to get more growth in the data center part of the business. So that's the opportunity for them in terms of that partnership and that linkage with Amazon.
Well, Tom, it's so interesting to me that you're already seeing kind of signs of that vertical integration, to your point that a lot of these people are looking for that company investment. Let's go to another corporate story here, which is kind of related. It has a lot to do with SoftBank, of course, the parent company. WeWork plummeting in the pre-market, the co-working company raising serious concern to go out of business. Is there a way back for WeWork, or is this story kind of done here?
Well, look, the company itself says that there is significant doubt that it will be able to remain in business. They are bleeding cash. They've had to, of course, cut headcount. We know that. They're looking to raise capital, they say. They want to renegotiate some of these leases, but they've seen membership numbers plummet. It is a very challenging time. The CEO who took over, of course, from Adam Newman, who ditched or left the company, was pushed out, of course, after that disastrous planned IPO. The CEO actually stepped down in May. They've had 3 changes at the top of the board. They have a 12-month plan now to try to resize and reset this business. But again, quoting from WeWork, they say that there is now significant doubt that this business can actually remain afloat. So it's going to be deeply challenging in the months ahead for this business.
Yeah, saying you have substantial doubt whether you can keep operating, not something that exactly inspires hope. Tom, thank you very much. Tom McKenzie there. All right, coming up, we're going to get back to that Italian bank story. Italy has issued a new clarification of its new tax on windfall profits for banks. We're going to have more on that shortly. And we'll be catching up with Skylar Montgomery Koning, senior global macro strategist at TS Lombard, trying to discern these summer markets later this hour. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Dani Berger in London. Italy has issued a clarification on its surprise bank profit windfall tax after lenders had some $10 billion wiped off of their value. For the latest, let's get to Bloomberg's Alessandra Migliaccio in Rome. Alessandra, walk us through what's actually been said. How much does it really change given the markets have already kind of had their freak out about it?
Yeah. They've definitely had their freak out about it. I mean, it was a surprise announcement, not expected in any way. We had drafts of, what the government was going to pass. 40% tax on banks clearly created a huge market rout, wiped out 10 billion, as you said. But, all of yesterday, the finance ministry, which is actually responsible for the norm, has been walking it back. They've been fixing it. So I think what the takeaway is, we don't even know at this point how much will have to be paid by the banks, if anything, because on the one hand, you have the finance ministry, getting into the technicalities and explaining that the levy won't exceed 0.1% of a firm's assets. Banks that have already increased the interest rates offered to people, to depositors, may not even have to pay much, et cetera, et cetera. And also, we have some evidence that in the past, because this is a retroactive norm, when companies have gone to the courts, they've won. So it's more a populist move by Deputy Premier Matteo Salvini, to make his electorate happy. They're very unhappy about banks not really passing on the interest rate increases to, people who have their accounts in banks. Banks are getting rich is sort of the thing that's getting out there, and they're not giving money to clients. And so Salvini is doing that for his base. Whether it actually affects banks in the end, it's not certain.
Okay. Alessandra, thank you very much for that update. Alessandra Migliaccio in Rome. Now, turning here to the UK, it's headed for 5 years of lost economic growth as the government fails in its goal to level up. That's according to the National Institute of Economic and Social Research. Joining us now is UK economy editor Reid Landberg. Reid, a pretty grim report. Look, I mean, we're not necessarily the most optimistic on the UK economy already, but what was your takeaway from some of what we learned in there?
Well, the really big picture is we've got sputtering and stagnant growth. It's a little bit of growth. It's not a recession. The worst does not come to pass. But equally, we're not seeing really good growth out there. And, NISA has identified a number of headwinds to the economy. We knew about the labor market. The labor market, 500,000 people dropped out of the workforce during the pandemic, and a lot of them haven't come back. But one of the other things they're identifying is that the Treasury is actually borrowing more, and that's a constraint on growth as well.
What does that have in terms of the read-through for the markets here? Because, look, this has been something that has been discussed at the likes of the IMF and even the World Bank for, I want to say, at least 1 to 2 years now. But in terms of the markets, we're not necessarily seeing, I think, the sell-off that a lot of people expected in the long term. When do we see that?
No, what's interesting is it's sort of tempering market expectations for where interest rates go from here. Just a month and a half ago, we were looking at interest rates topping over 6%. That would have been the highest in, this century, easily. Now, the market is looking at just a half-point increase more from here by February, and that might not even happen. So we're also seeing that weaken the pound a little bit as well.
Yeah, I forgot about that time, especially when we had what it was like almost 6.5 at one point priced into rates. So at least we've calmed down from there. But yeah, maybe not for a good reason if we're worried about this economy. Reid, thank you so much for joining. Really appreciate your time this morning. That's the Bloomberg UK economy editor, Reid Landberg. Now, coming up, some corporate news for you. Skincare brand L'Occitane said to be in talks on a potential deal to take the company private. That Bloomberg scoop is up next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London. Kriti Gupta is in New York. Now to a Bloomberg scoop. L'Occitane's controlling shareholder is said to be in advanced talks on a potential deal to take the skincare company private at a valuation of about $6.5 billion. Financing for the proposed bid has been lined up, and a deal could be announced in the coming days. Unfortunately, they were going to list it on in Europe. That was one of the options, so that's not happening. But it is more deal news because it's been tough for the deal makers. Now, speaking of them, bonuses for merger advisors are likely to tumble as much as 25% this year, though asset management executives will see a modest gain. Kriti, that's according to a report from Johnson Associates. So if you're planning on getting reincarnated as a banker, make sure that you're going to be in the asset management side and not the M&A side.
Well, Dani, I'm sure people have told you this. They tell me this all the time, is that you're still young. You got plenty of things to do. So maybe you and I can still take full advantage of that. But I think it's really interesting. It speaks to the idea that, look, maybe the kind of crisis that we are seeing in banking when it comes to even layoffs or kind of deal flow, that maybe there might be some sort of turnaround in line, by the way, with the turnaround you're kind of seeing in the economic data as well. Maybe this isn't as big of a kind of glut as or rut or whatever phrase you want to use as I think a lot of people were thinking it might be.
Well, this is the thing. I mean, I talk to private equity folks a lot, and we've talked to them on this show, Kriti. The refrain I keep hearing over and over again, whether it's on the show with us or private, is that post-summer is when deal activity is going to pick up. I keep hearing this over and over, but I'm not certain what would get us there, what would allow deal activity to pick up. Kriti, perhaps the only thing is that if interest rates are held steady, we can kind of adapt to this new normal. But there's always that threat that inflation really reaccelerates and the Fed will have to keep hiking even after the summer.
Yeah, I'll also add that maybe a new president might also change that as well. You do have, of course, have that antitrust risk as well that I think has chilled a lot of the deal flow, not just here, but around the world, and that could flip it on its head.
Yeah, definitely. I thought you were going to get into politics, a presidential election. I mean, that could also shake things up, too. All right, coming up, we're going to get to the macro story with Skylar Montgomery Koning of TS Lombard. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. China slides into deflation. The country's consumer and producer prices declining together for the first time since 2020. And it's so far so good for this week's historic Treasury debt auctions. 3-year notes getting a bid. And up next, we're getting the 10 and 30-year debt sales over the next 2 days. Meanwhile, SoftBank's ARM gears up for what promises to be the biggest tech IPO of the year. Amazon joins the party as a key investor. I'm Kriti Gupta in New York with Dani Burger in London. Dani, so much news to digest, so many cross currents, but it almost feels like the trade today is just a reversal of what it was yesterday.
Yeah, and it's a reversal in Europe, thanks in part to what Italy has done. It seems that this bank sell-off sparked by Italy saying that they would impose a tax on windfall profits. The fact that the market was spooked by that, we did have officials coming out and say, wait, it's not going to be that bad. Just 0.1% of your assets is the max you will get on those taxes. And if you're already upping deposits, what investors are getting if they're putting their money with you, then we'll leave you alone, at least to some extent. So that's allowing a rally both in European banking stocks and the FTSE MIB as a whole. Both are up just under 2%. And just want to point out in Germany, the bond rally we've seen has taken a breather. We're basically unchanged, not even 1 basis point move on the bund on the 10-year yield at this moment. So besides the Italian banking story, Kriti, not any really huge moves in Europe, a day perhaps of assessing of these edgy summer markets.
Yeah, and I think a lot of that sentiment perhaps feeding into the U.S. as well, specifically when you look at futures here. Green on the screen, Dani, higher by about 0.3%, 45.32 on those contracts for our radio audience. Look, the bond market gets interesting, though, because, Dani, to your point, you're seeing a little bit of a bid into the bond market, but you have to really go out into the curve to really see it this early in the morning. We're looking at a 30-year yield, at about 4.19, down about 2 basis points this morning. If you go to the front end of the curve or even further to the 10, you're not seeing that much action. So I wonder how much of this really is at the whim of those Treasury auctions that we're going to get. Again, we're going to digest that in just a few moments. Look at dollar yuan, though. I think that's a really important story. We are starting to see the Chinese economy, to your point, weaken just a little bit. And as we do, there is going to be more and more attempts for the PBOC to kind of step in. Today is the first day you are seeing that 3-day snap reverse, and that for the yuan, the dollar weaker against the offshore yuan, 722 we'll call it, weaker by about 0.3%. And I think that weakness feeding a little bit into the commodity story. The Bloomberg Commodity Index stronger broadly across the board, higher by 0.5%. But we should also mention rice in Asia, the highest level since 2008. This is a really big deal given that there is this element of protectionism, specifically coming out of India, which of course feeds not only the Indian population, the Indian diaspora, but a lot of Southeast Asia and simply the developing world, which relies more on the likes of rice than things like wheat or grain, for example, Dani. So this is definitely a story we're going to be wanting to watch when it comes to the way the international food security story plays out.
Honestly, if you want rice, come over to the Burger household. We literally have like hordes of rice, huge tubs. My husband always keeps some, which I never understand, but now perhaps it finally makes sense. Maybe we're the problem. Maybe we're adding to inflation. Okay, Kriti, a different topic. On a serious note, I want to bring a chart that got a lot of buzz yesterday. The New York Fed came out with a survey on consumer credit card debt in America. This number has topped $1 trillion for the first time. So this chart that we're looking at here, it ends at the end of May, so it's a little bit backwards looking. But still, you can see this really big run up here. This is the pandemic, and it just shows to what degree consumer spending is starting to increasingly be fueled by credit card spending. Now, the New York Fed did say at the same time that delinquencies were starting to stabilize and the consumer does look strong. But is that in danger of spending as a consumer continues to rack up debt? Let's talk about this and more with Skylar Montgomery Koning, who joins us now, Senior Global Macro Strategist at TS Lombard. Skylar, when you look at data like this and some of the other consumer indicators that we're seeing, do you see a consumer that's staying strong, that's still happy to spend, or do you see a consumer that's in danger of running out of steam?
Yeah, I think, credit card debt being at such high levels, it's just another avenue that squeezes the tightening cycle progresses. And it feeds into the slowing of the economy, right? So we're getting these little squeezes everywhere that eventually will add up to being quite a big squeeze. But as you've had this ballooning of credit card debt, there is a limit on how maintainable it is, right? There's a certain point where the cost of maintaining that debt makes it very hard to get out of it, where interest payments are very high, especially as COVID savings are depleted. And if consumers are spending an increasing share of their income on interest payments, that's consumption that isn't occurring in other parts of the economy, and it isn't feeding into GDP. At the same time, there's an effect through the banking sector. So the latest reporting season, we've seen banks report very large losses on loans. And loan loss provisions, that's not a new story. The trend has been rising loan loss provisions for 3 or 4 quarters now. But what we're seeing now is large losses, and more than half of those losses are from credit card loans. And this environment means that banks continue to tighten credit conditions, which in turn makes it harder for consumers to keep up with that debt. And that, again, slows the economy.
Skylar, when we were talking a lot about kind of real wages being under pressure, the concept of the wealth effect was really entering kind of the market conversation on Wall Street. What happened to the wealth effect, especially when you are still seeing a lot of real wages under pressure relatively to the last couple of years? You are seeing these union conversations. When it comes to things like credit card spend, which you just laid out, where does the wealth effect play a role?
Yeah, it's really interesting because we had this massive fiscal stimulus that happened during COVID, and we had these very high levels of savings, and that held the consumer strong for quite a while. But you're seeing that the declines you saw in equity prices and fixed income prices, just kind of the pretty ghastly market that we had last year, that's fed into the data in terms of the fiscal deficit, for example. Capital gains taxes, that was a significant decrease in the fiscal deficit in terms of it meant that receipts were much lower. And so there is some kind of impact that's feeding through in the same way that you're having kind of automatic stabilizers feed in terms of, higher cost of living increases has meant that people, that there's been more money spent on these kind of social programs as well. And so these kind of marginal things are having an effect. It's just kind of at the edges, and it'll continue to squeeze and it'll continue to have an impact. But the problem is that we're coming from such high levels and you're seeing a decline. So the question is just, when do we get to a point where it really squeezes the economy? We're now getting to the point where inflation is higher than wage inflation is higher than CPI. And so that means real wages are rising now, and that will continue to squeeze, and it'll also have an impact through margins.
Yeah. A very fair point, and it's interesting because there is always that lag in terms of actually seeing the real wages increase in the data and then someone actually feeling it in their paycheck. Skylar, I want to ask you about simply the stimulative measures that I think a lot of people are criticizing the White House for. For example, we are talking about squeezing, we are talking about the balance sheet from the Federal Reserve coming down, but at the same time, there are programs like loan forgiveness, for example, which again was very scrutinized by the folks who really need the Federal Reserve to tighten even faster. Walk us through that. How much of that is a problem for what the Fed is trying to do here?
Yeah, it's quite interesting because we've had this kind of stealth deficit deterioration in the US. So if you look on the face of it, the deficit looks pretty stable in terms of the CBO numbers for this year versus last year on the face of it are pretty much unchanged. But that's because of student loan forgiveness. So the program added $430 billion to the 2022 budget. And when the Supreme Court prevented the debt forgiveness, this sum was in part deducted from the 2023 deficit estimate. So without student loan forgiveness, your deficit for 2022 is under $1 trillion, and your deficit for 2023 is $1.8 trillion. Now, that's a substantial increase, and it's very unusual when there isn't a large fiscal package or there's not a recession. And in a weird way, as I say, even though the economy is strong, it's because of these automatic stabilizers, right? So poor market performance has meant capital gain taxes are down. On the spending side, the cost of living increases have meant increased spending on fiscal social programs, and rising interest rates have meant an increased cost of debt. So that increased deficit requires increased debt issuance. And so, in part, maybe that increased debt issuance helps what the Fed's trying to achieve in terms of it means higher yields and higher real yields, or this upward pressure on yield that will likely be maintained. But it has meant that we've seen a very strong consumer, and there's been more resilience to tightening policy than was initially expected.
Skylar, a little bit of a different topic, but it does feel that here in Europe and in the U.S., we've been able to kind of slightly ignore the property crisis taking hold in China. At least it feels like it's kind of been simmering in the background for a little bit at this point. But the fact that Country Garden, which has 4 times as many projects as Evergrande, was China's biggest developer by sales in the last 5 years. So a massive, massive property developer. The fact that they are under pressure to repay some of their coupon that was due on Monday, that they might default, has kind of reignited this. What are the odds that we might see the Fed hiking cycle come to an end because of a property crisis in China?
Yeah, it's interesting because it's kind of a parallel that's been drawn before, right? I think, what I will say is that the Fed is at the end of the tightening cycle. That's very clear. It's very clear that they want to wait and see how the lagged and cumulative impact of what they've done feeds into the economy. I think they're very comfortable where inflation is and the trajectory of inflation. I think what tells you that is that the SVB crisis, when that happened, they were very quick to pause. And so that tells me that if you do have an issue that you're worried about coming to U.S. shores, you're worried about impacting the U.S. economy, it wouldn't be that hard to get cuts from the Fed. And, they're angling towards Fed cuts in 2024, even if they get a soft landing. So you'd imagine if something goes wrong, it's not that hard to get deep cuts now. If you look at the past 10 cutting cycles, the Fed has cut when CPI is averaged at 5.8%. We're lower than that in headline terms. Core is around that level, but I think it tells you that they're comfortable. The question is just, how much contagion are you really getting from China in terms of we've had these rounds of disappointment, and property has continued to be an issue for China that they're kind of slowly dealing with. And so I think there's less of a risk of that contagion really coming to the U.S.
Yeah, really hard to kind of make those historical parallels, Skylar. It's going to be interesting to see how in 10 years we go back and look at how this is all paying out. Skylar, Montgomery, Koning, we thank you as always for joining the program. Coming up on the show, we go micro. Disney reporting its quarterly results after the U.S. market closed. From streaming profitability to Bob Iger's restructuring plan, even a labor story. We're going to dig into all of it. Stick with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Dani Berger in London. Disney reports its latest results after the U.S. closed today. Investors looking for commentary on progress the company is making towards reaching profitability in its streaming business next year. For more on what to expect, we're joined now by Geetha Ranganathan, Bloomberg Intelligence's star media analyst, I might add. Geetha, thank you for waking up early and joining us this morning. Let's start there. The profitability plan for Disney. The last we heard, I think, from Bob Iger himself was that there are potential plans to spin out the likes of ABC, for example, and really hone in on those cost-cutting measures. What might that look like?
Yeah, definitely Bob Iger juggling a lot of different balls in the air, Kriti. So this is going to be a really pivotal report, because if you've kind of just looked at Disney stock over the past few months, sentiment has really deteriorated. And there are a lot of pending questions, as you just kind of alluded to. So yes, he has said that the TV network business, which constitutes the Disney Channel, the ABC broadcast stations, the ABC network, a lot of channels that they acquired from Fox, they are no longer core to Disney. They are non-core assets, and he does not mind spinning them out. So it's going to be interesting to see if they've made any progress on that front. Having said that, though, I mean, these are businesses that still throw out a lot of cash. So, yes, they are in secular decline. Yes, cord cutting is a thing, and it is getting really, really, dangerously high. But still, it does generate, the business does generate, ex-ESPN, the business does generate $3.5 to $4 billion in EBITDA every year. So, they're going to have to see what plan they can come up with, and it'll be interesting to see what Bob Iger has to say today.
Does the ESPN and their contract with Penn that we learned about yesterday, Geetha, fit in all of this? Of course, Penn, the casino company, signing a deal with Disney's ESPN to use some of their licensing, maybe helping ESPN get into the online gambling business. Well, where does that fit into this overall structure?
Yeah, I mean, I think it actually fits in just perfectly. So it provides them with much needed cash. So about $2 billion over a period of 10 years, $1.5 billion of which is in cash. And what it does is it's kind of this really low risk move for ESPN because they're not directly getting into the online sports betting business. I mean, Bob Iger really never wanted to do that. I mean, ESPN does have, or Disney does kind of have this family friendly image. So I'm not really sure he wanted to directly get involved with regulation, with all of that stuff. So this is kind of a really neat, clean way for ESPN to kind of reap the benefits of online sports betting without necessarily getting into all the the nitpicky, dirty details. So I think it's a really good move for ESPN.
Geetha, I had the most fascinating conversation yesterday with someone in the creative industry who was talking about the length of some of the labor strikes and basically the hit that a lot of these streaming companies might be able to withstand, but also ultimately take. To me, when I ultimately heard about the likes of the writer strike, for example, the time frame that was given was that the record number was about 100 days back in 2007. Now it feels like into the conversation, people are forecasting this could last upwards of a year. In terms of timing, Geetha, talk to us about the read-through into the bottom line for the likes of Disney.
Yeah, this is a really tricky situation, not just for Disney, Kriti and Dani, but actually across the industry. I mean, content at the end of the day is the lifeblood of all of these media companies, and you need new content. You need fresh content to kind of keep viewers engaged and keep them coming back to your platform. So yes, ironically, the strike has actually been kind of this blessing in disguise for the bottom lines of these companies because there's been so much of focus on profitability, on free cash flow. We saw Warner Brothers Discovery actually post a little bump in their free cash flow. We saw Paramount, which just reported, also say that their free cash flow is much better. And then Netflix, most notably, has kind of raised its free cash flow guidance to almost $5 billion for this year. And that's all because of these labor strikes. They're not spending any money because content has come to kind of this screeching halt in Hollywood. The thing is, yes, it's fine in the short term, but yes, if the strikes do extend, if they do spill over into 2024, all of these companies, including Disney, are really going to be in a mess because, again, you need content, you need that for your top line growth, and that's not going to happen. With Disney, it's also even more, I think, there's a sense of urgency just because we've kind of seen a lot of their film titles, their recent film titles underperform. And so it's really important that they get that content engine, that they fix the content engine, which seems a little broken at this point, and kind of get it re-energized.
There does seem to be a lot of hype around movie theaters right now. I mean, we know why it is. I hesitate to say the names because I feel like we've uttered them so much of the movies these past few weeks. They've gotten people into the box office. Geetha, is there any read-through, or is it just two movies that has everyone excited, that had a huge marketing budget? Or are there any expectations of a revival of a consumer who wants to actually go see films in a theater?
Yeah, we've kind of seen this on again, off again kind of box office recovery pattern for many, many months now, Dani. And I think that's a really, really important point that you bring up. I think the key takeaway for the industry is if there is fresh content, people, first of all, are interested in seeing fresh content, original content, which is what we got to see with, both Barbie and Oppenheimer. And they've just done extremely well, not just domestically, but they're playing very, very well in global markets as well. And then you kind of contrast that to the likes of Disney, right, which comes out with, Marvel or, Indiana Jones or even some of its recent Pixar movies. They've just not done that well. And so there seems to kind of be this tiredness or this franchise franchise fatigue, if you will. So I think that the real takeaway is, if these studios can come up with fresh IP originals, then people are definitely willing to, pay the bucks and go out in the theaters to watch them and enjoy them.
Geetha, I want to ask you a final question simply about that, which is that, and I would say the labor strikes as well. Let's fold in the concept of artificial intelligence here. If one of these sticking points of the labor conversations, of the way movies are made, is the use of AI, why are some of these media companies perhaps not trading on that kind of AI frenzy that you're seeing with some of the other stocks?
They have to be careful, right? It's a very it's a very kind of tricky balancing act, if you will. Yes, they need AI to kind of cut costs, but at the same time, AI is, as you just pointed out, the sticking point with many of these writers and actors. They don't want AI to replace them, and so I think the way that these media companies have to position the argument is to kind of show how, by embracing AI, they can actually enhance creativity. They can enhance the imagination of these creators. And so it's something that they can, creators need to work in harmony and not necessarily view it as a threat. But that's kind of a difficult, I think, pill to swallow for a lot of the people in the creative community. So they do have to be careful. It's a double-edged sword.
Yeah, I got to say, I don't think I would want to be a Hollywood executive right now. Geetha Ranganathan of Bloomberg Intelligence, we thank you as always for joining the show and previewing those Disney earnings for us. Coming up, a look at some of the market-moving events to watch throughout the day. Stick with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Dani Berger in London. Let's take a look at some of the stocks we're watching in the pre-market trading. This is the big one. Disney earnings reporting after the bell here. Already seeing a bid into the shares, higher by about 0.8%, trading at about, we'll call it $88 a share, 89 if you're feeling comfortable. Look, they're dealing with a lot here because just in the last 24 hours, we also got news about a partnership between Penn Entertainment, of course, the gaming company, and Disney's ESPN. And that, although fueling some of the Penn National Gaming shares higher by about 13% this morning, is fueling a little bit of sell-off in some of their competitors, like of DraftKings, for example, down about 6.4%, or even Flutter Entertainment following that lead. So seeing a little bit of some movement when it comes to the streaming space and, of course, the gaming space as well. Another major stock to keep your eye on, I would say maybe not a massive stock, but a massive story, if you will. WeWork shares, the ticker is WE, literally trading at 18 cents. On a percentage basis, of course, it's going to be a massive move down, about 17%, just given it's a penny stock. But what you need to know is that they are slumping. They're saying there's substantial doubt about the future. Is this the end of the era for WeWork? And remember, still, the majority shareholder of WeWork is SoftBank at the end of the day. So really keep an eye on the ramifications of that. And lastly, Dani, I'm going to leave you with this one. Lyft shares sliding down about, we'll just call it just shy of 8%, trading just shy of about $11 a share, posting their slowest growth since the pandemic. This is really interesting because when we got the numbers out of Uber, they actually posted profitability, a profitable quarter for the first time in their history. So seeing a real divergence between Uber and Lyft, but of course we know Lyft is just a ride-sharing company. Uber does a few more things than that.
Yeah, I think really the two events to watch. One, it's going to be those Disney earnings that you mentioned. The other one, 6 p.m. UK time, 1 p.m. if you're in the U.S., is that 10-year auction. $38 billion, Kriti, is what's coming up for sale. 3-year auction yesterday, that went off smoothly. There's going to be this question as to whether the yield is enticing enough on the 10-year. But then tomorrow, it's going to be even a more difficult one, a 30-year auction. That one is usually even difficult to push through, too. And, Kriti, this is concerning, or at least the concern is the deficit in the U.S. Are they going to be able to get these auctions done smoothly when the amount the government is taking on in terms of debt just continues to grow?
Yeah, I think that 30-year is really the hard one, to your point. Remember, has those ramifications for what the rates do for longer-term assets like car loans, like mortgages, et cetera. So really keep an eye on that one. That does it for Early Edition. Surveillance is ahead. Tom, John, and Lisa are going to take you from here. Stick with us. This is Bloomberg.